Hey everybody, this is Shelby Miller with Keller Williams, and I am with Tricia Literati, my partner in crime with Keller Williams. And today we have Mike Thompson with Envoy Mortgage. And Michael, we wanted to just ask you to share with us a little bit about what's going on right now with COVID-19 and the whole mortgage forbearance. What is that? Let's educate people in case they can't make their mortgage payment.
Okay, it's a great question. It's very timely. It's very important that people understand this and really look at all their options. Pardon me. But the government has created the CARE Act, and the whole design here was to assist homeowners whose income may have been affected by the coronavirus. One of the components of the CARE Act, and there's many components to it, is the possibility of mortgage forbearance. And what's a little bit frustrating and challenging is the headlines that have come along with that. Because forbearance is often misinterpreted. It's intended to help. It can have some dangerous repercussions, though, and many people are mistakenly thinking that forbearance equals forgiveness, and it simply does not. Forbearance simply means that the payments will be suspended for a short period of time. Initially, it's up to 6 months, but at the end of that time frame, the payments are going to need to be get caught up, and that's what I think a lot of people aren't asking about. What happens at the end of forbearance? So I'll do this analysis, and if you've ever bought furniture and they give you a 3-month payment holiday, at the end of the day, you still pay for the furniture. It's just the payments are kicked down the road a little bit to a later date. Mortgage forbearance, though, is much worse because you could be really digging yourselves into a deep hole, and it may be difficult to catch up. So should this happen, the servicer has the right to be paid. And this could lead to foreclosure. So imagine if you've been in your house 10, 15 years, you have a significant amount of equity, you do a mortgage forbearance, and they give you, let's say, 3 months off, your mortgage payment's $2,000 a month. The way most forbearances are written is at the end of that 3 month, they would want $6,000. And if you don't have the $6,000, then a couple different things can happen. They can spread that $6,000 over an extended period of time, and that could be anywhere from 6, 12, 18, 24 months. But imagine coming out of this 3 months, let's call it, of not working and having a mortgage payment that's significantly higher than where you were before the virus happened. So, that's a quick overview as to what's happening. Now, the unknowns are really, well, if they won't spread it out over payments, what else can happen? So what else can happen is they can extend the term of your loan or do a balloon payment. A balloon payment simply says that $6,000 would be due at the end of the term of your loan, or some lenders are also, or servicers I should say, are just extending your loan term however many months you went through forbearance. So if you had a 30-year term and there was a 3-month forbearance, then you would basically have a 30-year and 3-month mortgage from that point. But what a lot of people aren't realizing is they need to contact their servicer to see what their options are, because that's the person who makes the rules, and that's really who they should be talking to. Just don't start skipping mortgage payments and expect that nothing bad could happen.
That's really good advice. So other options besides doing a mortgage forbearance, any tips, suggestions?
So besides the forbearance piece of this, we could also take a look at least from my perspective, as to, would a refinance give you the relief that you're looking for in a forbearance? A refinance, if you're in an equity position, we can take a look at possibly going backwards in terms. So, maybe you've been in the house 9 years and it was a 30-year loan. We could take a look at going back to 30 years and lowering that mortgage payment. But the other thing we're doing for a lot of families right now is taking a look at the overall debt load. And if they have equity in the house, does it make sense to roll some of that debt in with the mortgage, so then your overall debt load is less, and that's also giving people some relief. The one thing to keep in mind with a refinance is you're going to skip 1 to 2 months of mortgage payments, and you're also going to get an escrow refund, and that really can give some people the relief, the temporary relief they need right now until this virus passes through.
What happens if someone's not working that? Like, how you can't, if somebody's out of a job, you're not going to be able to refi, right?
So the statistics right now are about 10% of the country's out of work. Okay. So that means the other 90% is working. The key to us is, where are you going to be at when the loan closes? If you're working, then obviously we can close the loan. They have really tightened down in terms of what lenders require to validate that somebody's working when that loan closes. So typically verification of employment, we needed them 10 days before. Now we need them 72 hours before closing. So they've tightened that up. And for self-employed, they want to see a year-to-date profit and losses and make sure that the revenue drop has not prevented your ability to pay back the loan.
Okay.
So, Michael, we were just joined by Tom Marino, who was actually the financial advisor guest that I had last week that was talking about helping people kind of conserve money and everything else. So, Tom, do you, as a financial advisor, have any questions for Michael in regards to what's going on with all of this?
No, it was actually good. Just cut the last few minutes, and that was actually the information I was looking, because I have gotten a couple questions on what options are out there to people, and I just like to be up to speed on all that. So,
yeah.
But the employment is going to be an interesting question, because I think that's going to be a difficult point for refinancing side of it.
So, go ahead, Michael.
I do have one quick question, Michael. I mean, do you envision? I guess we get the mortgage industry through the 2008 crisis,
yes,
and some of the issues that they took then. Do you anticipate similar actions to occur?
I think these are going to be different. These are different circumstances. We didn't have this mass unemployment that we're experiencing with the virus. The financial crisis, I think, was just a different animal. So I think there are similarities in terms of the Fed stepping in and providing liquidity in certain cases and stimulus packages. But for the most part, I think this is something that's going to heal itself much quicker, because when this virus ends, I believe things will rebound and life will, let's call it, go back to normal, hopefully. So I think it'll be a quicker rebound than what we saw with the 08 financial crisis.
Okay. Yeah, I was wondering what the chatter in the industry was been like, if there's like anticipating
it changes daily, unfortunately. It's, you're scared to open up your email and see what the latest announcement is. But it's very, very interesting times.
So, Michael, you know that we're recording this, and Trish and I are going to be utilizing this on our business Facebook pages. So it's going to go out to our potential buyers that right now believe they may be pre-approved, and maybe that's changed. Can you talk a little bit about how things have changed in regards to government loans for home buyers now as well?
Sure. If anybody was, let's say, pre-approved to buy a house before February, I would highly recommend they reach back out to the lender and make sure they still qualify. The biggest changes we've seen so far is the elimination of some programs. I'll talk about that second, but also credit restrictions. So now, let's just say for most loans, credit score requirements have gone up. An example of that is we used to do FHA lending down to 580 FICO. Now our minimum credit score is 620 or 640, depending on the scenario. And then conventional loans have pretty much gone from 620 to 640, same with USDA. So those people that thought they were pre-approved right now may not be pre-approved based on those credit score requirements. There's also on government loans the need in some cases to have reserves. What reserves are additional assets post-close. And the idea there is if they have a 2 to 3 month reserve, that's a cushion that they could fall back on if it's tough to manage their mortgage payment the first couple months into it. In terms of products being canceled, it really has to do the jumbo market has really dried up. Wells is the largest jumbo lender in the country, and they pulled out of correspondent jumbo lending last week. So that has changed. And we've probably seen 70% of our jumbo lenders disappear, where they're no longer taking applications. And that's just to be clear, that's a loan amount above $510,000. So if you had a buyer that was looking to buy at 650, we still have options. We can do what's called a piggyback loan, where we would do a $510,000 conforming first mortgage, and we would put the rest of that balance onto a home equity line of credit. It keeps it in the conforming loan limit world, and it's a way that we can still help the people that we're looking to buy houses, let's say above a $600,000 purchase price.
So if there was a jumbo loan in progress already and we're getting close to settlement, is there any issues with that being pulled at this point? Or do you think it'll be?
So what we're seeing is if right now, if investors are canceling programs, they're canceled. Now, I had a couple scenarios where the credit score was below 620 on some FHA lending. As long as the loan was underwritten, approved, and locked, then we would honor that commitment and still close on that transaction. But there are some jumbo programs where if they pull the plug, it's stopped. It doesn't matter where it's at in the pipeline. The reason for it is the secondary funding on jumbo loans is different than it is on conforming or government loans, and that would be the reason why some of these just stop altogether.
Okay.
So, Michael, I had a newer agent in our office come to me over the weekend and asked me, she's submitting an offer virtually on a house, and I asked straight out, what type of loan, is your client using? And she said USDA. So my first suggestion to her was, you need to call that lender, and you need to ensure that she can, still purchase. And she made the phone call, and the lender had said, oh, well, because you're not looking until the mid-July, you should be okay. Go ahead and write up the offer. And so I guess my question to you is this a temporary thing that we think is going on with these loans, where, like, okay, the buyer, if she were to put an offer in and want to settle within 30 days, forget it, she can't, but maybe in a couple months, things will be back to normal.
We hope things will be back to normal. What I'm doing with my pre-approvals is I have a backup plan. So when I present them loan options on a specific house, and I had this yesterday actually, where a couple wanted to do USDA financing. And I said, well, let's also look at FHA just in case. And it was very unique because the way we present this, I've never done it before, but we went to the seller and said, we are submitting this as USDA. And let's say the purchase price was $200,000 with no assist. But if for whatever reason we can't do USDA financing down the road when this is ready to close, then we would like this written in as an addendum where they can flip this to FHA. The sale price would then go to 207, and they get the seller's assist that they would need to still be able to buy that house. So we have found creative ways to have a backup plan in case, let's say, a no money down loan such as USDA would disappear.
That's very interesting and creative. Thank you.
Yeah.
Things are just changing so fast. It's like, I mean, we were talking the other day and about appraisals. Now we're hearing maybe it's going to be drive-by again. We just got the okay to go in, and now I just talked to an appraisal a couple minutes ago, and he's like, nope, PA's shutting it down again.
Yeah, for the most part, it's all drive-bys or desktops, which that can be a good or a bad thing. It depends how it's looked at.
Yeah.
It's probably better for the appraisers. I just got a call from an appraiser while we were doing this, and they're scared. They're going into homes, they don't know what they're getting into,
right?
And we got to protect everybody. And I've had some people complain that appraisers are still charging the full dollar amount, a normal fee for a desktop or a drive-by. And I'm like, you just need to understand what these are like the EMTs of our world, where they're out there on the front lines, just like realtors are. And I believe that their compensation shouldn't be cut just because of that.
Right.
Tom, do you have any further questions that you might have for Michael before we wrap this up?
I don't. I just appreciate the quick update. So thank you. I'm going to scoot out, and it's an evolving market. This should be like almost a daily broadcast.
I know. For the updates, I know.
We did one 2 days ago, and I'm sure that there are certain things that have changed in the last 48 hours, and they'll probably change over the weekend. It's definitely interesting times.
Yeah. So thank you, guys.
Thanks for popping in, Tom. It was nice to see you. And Michael, I want to thank you for taking the time to educate us. And like I said, I appreciate being allowed to record this so that we can share it on different venues of social media.
Great.
Thank you. Oh, Michael, in case somebody has questions and they want to reach you, and this is Zoom, so I can't automatically just push something onto it. How can they reach you if they have further questions?
Cell's best. It's 215-681-8407, 215-681-8407. Again, it's Mike Thompson, Envoy Mortgage.
Michael, thank you. Thanks, everybody.
Have a good one. Thank you.
Bye, guys.
Bye.
All right. So I stopped the recording.
It still says recording on my end.